Welcome back, traders and investors. We have Todd Schoenberger on the line, and he is now president of Streicher Asset Management LLC. Todd, tell us about your new gig here.
I'll be happy to. I was, as you know, the portfolio manager of the Land Cold Onshore Fund. And so now, after careful consideration, we are now going to, I've decided to join Streicher Asset Management, and I'm going to fulfill the role of president of the asset management division. And I'll also continue to be the portfolio manager for the Land Cold Fund, which will be distributed exclusively through Streicher. So I'm very excited for this opportunity. I think it's a win-win, obviously, for me and Land Cold, but also for Streicher. So we have a lot to look forward to.
And how much assets are you going to have under management now?
Well, total combined for the entire organization, we are a multi-billion-dollar firm. When you look at all execution, we have an investment banking division. We're also a direct market maker. We have a floor presence at the New York Stock Exchange, and then obviously with the wealth management, asset management side. So we're expecting to see these numbers grow considerably in the short term. But right now we're obviously starting off on a really nice base.
Okay, so last time I had John, you were a pretty bullish guy. And the market ran up and made some new all-time highs here during earnings season, but now we've pulled back a good 60 points from the high. We're having a bad morning here. How are you playing this pullback?
I see this as a wonderful buying opportunity. I mean, we are looking at, going into yesterday's trading, we were about 3.7% off of that high in the S&P 500. And right now, I still don't see the evidence that's there to suggest that we are going to enter a correction mode. I mean, this is a stock market that has not had that 10% correction in the last 3 years. And there really isn't that concrete evidence to suggest that we're about to begin something. I mean, here you had last week we had on the heels of the GDP data, which was good, and then you had the jobs report. We had a sell-off on Thursday, continued selling on Friday, and then we rebounded yesterday, which was not to be unexpected. It was the first trading Monday of the month, which has historically shown an up day. And now we're having a little bit of pressure today off of the data that's coming out of China. So this week, though, we are very weak on economic data, and we don't have anything that's going to be truly influential. So if you're looking for something that's going to move markets, probably it's going to be from headline news, from geopolitical news. And right now, even that news seems to be a bit positive for what it's worth. So with that said, I think if we're going to sell off today, it could be a great buying opportunity for the rest of the week.
What would it take to change your mind there, Todd? Like, would we have to hear more concerns, geopolitical concerns, or would you have to, because we're coming out of earnings season now here, so I don't really see, well, I guess we're towards 2/3 through earnings season. I don't really see a catalyst coming from that way to drive us back higher. What would change your mind to make you a little bit more bearish?
Well, I would have to. I'm bullish for the rest of this year. I will be bearish next year when the Fed begins to change monetary policy and starts to raise interest rates. And I think that will be your catalyst. That's going to be your pinpoint mark to then say, okay, the bears can come out of hibernation. Right now, though, I mean, keep in mind, after the first quarter this year, you went through a negative GDP print of 2.9%. You had the polar vortex. You had all the other geopolitical issues that were taking place. Yet the stock market continues to go up. And historically speaking, the conventional wisdom would suggest that would be the excuse to start selling stocks. But we haven't seen it yet. And therefore, I just don't see anything on the horizon right now to suggest that we're due for a correction.
Okay, go ahead, Dennis.
It's a great point. Obviously, we've had so many excuses to sell this market, and it's been the honey badger market there, where it just seems to ignore all these excuses. So I get where you're coming from there, and I guess if the trend is your friend there, we've had these 3 to 4% pullbacks before, and they've worked out if you've bought them. So you think this is the same type of deal here?
I definitely do. And I mean, we can look at all kinds of historical data. I mean, we can argue about it, I mean, for weeks. And I mean, look at the PE ratio of the S&P 500. You're at, 15.4 The historical norm is 14.5. And I mean, we still don't have that quite pricey market, the overvalued market to really warrant a sell-off. And like I said, conventional wisdom would tell you that we are due for a correction, and that's fine, but it doesn't mean it has to happen. And therefore, going into the rest of this year, well, clearly for the rest of the summer, I see stocks just continuing to hit higher highs.
Dennis and I have been noticing a lot of these earnings have been coming out, and the stocks have been popping, but it's really been pops to fade here. It just looks like people are taking the good news as as an excuse to sell. A stock like Coors at $95 in pre-market trading, and came all the way back and gave some back. What do you think is is causing that that mentality? And have you observed in any of the issues that you own?
Yeah, the only thing I can think of is during the earnings conference calls, analysts are not hearing that real, true, bullish sentiment, that optimism that you ordinarily would think that you're going to hear. And I'll give you an example. Michael Kors reports yesterday, and what do they have? They have 62% profit margins, which are just sensational. And then they also talk about their international buyers that are coming in. They're not getting a lot of U.S. domestic buyers right now, but it doesn't matter. Their earnings were fabulous. And really, the statement itself actually was quite bullish. But as I understand it, the call, it just was kind of benign. There wasn't a tremendous amount of excitement. And I think you could go also look at Facebook. I thought Facebook's earnings were just insanely great. And, I mean, when you start looking at their mobile ad revenue, considering it's 62% of their total revenue base right now, whereas, 15 months ago it was near zero, that is, if you look in the dictionary for definition of hypergrowth, you're going to see the Facebook logo. Yet the stock actually immediately sold off right when the earnings came out after hours, and then popped up again, and obviously had a nice trading day the next day. But there does seem to be that immediate sell on good news, but I think that eventually you're going to have buyers that just come in and just overlap that and start trading higher and setting valuations, really much higher at that point.
Do you think people on these Facebook mobile ads, I've been talking about this for a while too, do you think people actually do click these ads? Like, I mean, they might click them off the bat here, but I'm on Facebook the odd time there, and I never seem to click these ads. And I just wonder, if everybody's jumping on the Facebook ad bandwagon, but once, you get the metrics coming back from individual, like, are they really able to, are people really clicking these ads in the Facebook?
I believe they are. I mean, when you look at right now, they have a base of 1.2 billion users. Their monthly mobile users averaged 1 billion. This is worldwide. Yeah. So when you start thinking of advertising and just the reach to reach that many people, you really can set your rates. I mean, you're not only a category killer with your product, but you are with how you're actually bringing eyeballs to those advertisements. So granted, people might not be clicking on the ads, but they're seeing the ads. There are ads that are there that do have content that you don't necessarily need to click to see more, or it is obviously an option. But also keep in mind the thing with those companies, with any of the social networking companies, a lot of it has to do with content. Well, actually, it has everything to do with content. But I take a look at a company like GoPro, which really has been getting hammered, and analysts have not been backing this thing because they're so focused on the unit sales of these cameras, and that's fine. But the content that GoPro has and what they've been acquiring, if they can monetize that, that's what's going to be great for GoPro. It's going to be great if they can have partnership or distributions with companies like a Facebook or a Twitter, because when they do that, that's where you're going to really start seeing the real revenue coming in. It's not just going to be on those unit sales.
That's interesting. So looking on the pullback here, what are there any particular stocks that have been exhibiting some weakness that you like to pull back here, or any particular sector that's catching your attention?
Well, I'm kind of surprised by the retail sector right now. I mean, here you had back-to-school shopping. The numbers that have come out have been really, really bullish. And I guess it hasn't been a headline news because we're just in the beginning of August, and and kids they're not even thinking of school. I know in the South they'll be going to school in a few weeks, but back to school shopping has actually been quite robust. So I would expect to see companies like the Targets and the Walmarts do a little bit better. I know Target's getting a hit today off of their news that they're actually downgrading their earnings release because of the data breach. But going forward, though, you can only suspect that companies like that will do well because of back-to-school shopping. And then also, remember, back-to-school shopping is a great proxy. If it does well, it's a great proxy to show us what holiday shopping is going to be like. So I think that's one of those areas you can focus on. Travel and leisure stocks, something that a lot of people don't talk about. But these airlines have just done sensationally well. And I was a little bit skeptical once the Malaysian Airlines flight was shut down. But after that, I mean, you really have seen a great uptrend on a lot of these companies like the Southwest, the Deltas of the world. So that could be another sector to focus on.
What about thoughts on Disney earnings tonight? Do you follow Disney, Todd?
I do follow it, and only because for my son, he has the Disney stock. But I will say, I'm a big fan, obviously, of Disney. But where they make their money isn't even necessarily on the movies; it's on the merchandise sales of those movies. And you think of some of the franchises of this company. I mean, what they have had and what they've launched in movie distribution, but also what they've sold as far as the royalty rights for a lot of the merchandise. That's where the real number is going to come in. I'm anxious to see that earnings report, only to hear what they've been selling on merchandise. Obviously, the parks do great. It costs quite a bit of money to go to these parks. You guys may know, and when you start thinking about these types of companies, as far as the discretionary income for people, Disney has not taken a hit. I mean, you still have quite a bit of demand from families that want to visit there. So that will also do well for Disney. But also the stock is doing fantastically well. I think it clipped its 52-week high, or if it didn't, it's dancing with it right now. And I'm sure the earnings release will set it even higher.
Sorry about that. We are getting some major storms rolling through the area here, so that's probably causing a little bit of static. But, Todd, I want to ask you, I mean, besides all the buying that's going on here, how about you doing any selling? And I want to bring up a stock like Microsoft here, who had, the back-to-back days of really good news, got to a multi-year high, and then actually, came out with the earnings and stuff. Have you been trimming profits in anything, or taking profits in something like Microsoft if you're in it? Or, I mean, when you see 2 days like that in a stock like Microsoft, I mean, it's just so out of the norm. Does it get you a little bit itchy to perhaps take some profits in it? Not necessarily Microsoft if you don't own it, but, stocks that make these normally are 30, 40, 50 cent moves, and then, they gained $4 in 2 days?
Yeah, I don't own Microsoft, but I will. I do track it, and I do follow it only because it's old technology. And there was a time where analysts thought Microsoft was like a utility, and it just wouldn't trade. So when you see that type of volatility, when you see a bit of a pullback, yeah, it would be a good idea to lock in those gains. It's always a good idea to lock in gains. I will always, as a trader, you always want to tell your clients that take advantage while you can. But one sector I would caution your listeners to stay away from is real estate. And in the Land Hold Fund, as you guys know, I mean, that's one of the components of the Land Hold Fund. We trade long and short on real estate. And right now, I'm very bearish on this sector. I mean, only because the data that I've seen in what was considered the peak home buying season, it's just not there. I mean, new housing projects right now, they're trended down to just about 890,000 annual new homes are being built. That's really bad. Anytime that you're below 1 million, that's not good. And we were really expecting that great Gatsby recovery for real estate this year, and it just never happened. So when you start thinking about the third and fourth quarters this year, that sector is going to be, I would consider it poison. But also the spillover effect is on the jobs report, because one thing that you do like to see is new construction jobs coming into play late in the summer, because there's so many homes that are being built. And without new homes being built, I think that's going to have a negative spillover effect on jobs reports in the next couple of months, because the construction jobs used to be able to pick up the slack, and they're probably not going to be there. So just a couple of warning signs for your listeners, but real estate I definitely would stay away from.
Okay, Todd Schoenberger on the line here. He's president of J. Streicher Asset Management, giving us a very well-rounded view of the markets. Todd, thanks a lot for the information you're providing to our listeners, and we hope to have you back on again soon.
Absolutely. Thanks for having me, and have a great day investing today, guys.
Okay.
Thanks, Todd.